Well, good morning, everybody. It's now the end of the first quarter of 2024. We've had some big news in the housing market this week. So we're going to explore some of those things. In particular, there was a latest development in the commissions lawsuit, the realtor commissions lawsuit. And so while we don't know exactly what's going to play out there, in fact, we can start to speculate, and I'll point out some of the data that I will be watching for to see if the market reacts to any changes in how the industry works. There's no data yet. Of course, things are brand new and not even finalized. So, but it's big news, and it's big news for consumers. People are asking if they haven't asked you about them. They've asked me about them several times already, friends, and about the latest development in the commission's lawsuit. And so I think it's probably important to be able to communicate what's happening and what could happen for the market and what we can watch for with those communication with those lawsuits. Also, the Fed met yesterday. The Federal Reserve met yesterday, and we're in a very interest rate sensitive time in the real estate market. So we're going to explore a little bit about what that means. But mostly, we're going to dive into all the details, all the data, and look at what we know for 2024. Altos Research tracks every home for sale in the country every week, all the new supply, all the pricing, all the pendings, all the changes in that data, and then we make it available to you before you see it in the traditional channels, and especially for your buyers and sellers to see it in the headlines. And there are still folks on the sidelines who think that home prices are falling, for example, or that once rates finally come down, that we'll see a flood of inventory. And they need you to help them see the data real clearly. So what we're going to do today, I'm going to share a few things. Let's start with a little, I like to just give a little quick overview of Altos. So at Altos, we're tracking every home for sale. We're doing all that data. And what we do is we bundle it up for professionals in the industry to communicate to their buyers and sellers, to people who need to transact on the market. We do with market reports, and I'll show you some of the market reports, but those are branded for you. We have the systems for using it in your business, and then our advanced analytics, which we'll do a little bit of time with today also, where you can do deeper queries and ask questions and compare over time. And so all of those pieces make up the Altos system. And so if you need to communicate with buyers and sellers, I recommend that you go to altosresearch.com and just book time with our team. We can dive into your local market. During the conversation today, please use the chat. We have Jeff and Lael from the Altos team who are in the chat. When I talk about things, they will drop links in the chat so you can go click through if you want to go, for example, register to get a free look at what Altos does for your local market. You can go do that in the chat. And so, and also if you have questions along the way, I can't answer the questions as we're doing the talking, but Jeff and Lael will try to field questions about the data as we're going along. And then I'll stick around at the end of the webinar to make sure that all the questions are answered. The webinar is recorded. So if you've registered and you're here, you will be able to see that. You'll get an email later today when the recording is available, and you'll be able to watch it again. You can share it. It's on our YouTube channel every month, and so you can go pay attention to it there. So, and I always like to remind, if you haven't already downloaded the Altos ebook, How to Use Market Data in Your Business, you should do so now. This is the data that I cover today is in this ebook, how to talk about it, where you get it, how you can reference it, what people need to know. There's ideas, there's scripts, there's strategies for communicating with consumers. So there's a link in the chat to go get that ebook. If you haven't already done so, I highly recommend it. Let's dive into content. So we're going to start with the mortgage rates, the Fed meeting, and then we'll spend some time with inventory. Inventory is ticking up. Where is it going for this year? And then we can look at all the leading indicators for the rest of the year. We know a lot about prices and inventory and sales trends. Some of those are optimistic signals. Some of those are not super optimistic right now. The market is shifting from where I was much more optimistic at the beginning of the year. There was more signal for strength. As mortgage rates have basically been rising since January 1, we can see really clearly where consumers are backing off, which markets are being slowed most quickly, and where consumers are not backing off. So we can compare a bunch of those elements, and we'll do that in some of those local markets today. And then, as always, while we're talking about the data, I will try to help you know how to communicate with buyers and sellers. So not just to you, but to the end consumers who are needing to understand the information right now. So I'll try to keep that in mind as we march along. Okay, let's dive into some data. So the Fed met yesterday. The Federal Reserve Board met yesterday, the Open Market Committee. And they have reiterated that they are planning for 3 interest rate cuts through 2024. What you might have heard about is what's called the dot plot. And what the Fed does is each member on the committee has a vote of where they think rates should be and where they think rates will be in the future. And when you look at the dot, and we can start on the left side of this chart, each dot, you can see there are 2 sections. There's the left half and the right half. The left half is from where people believed it was a quarter ago in December, and the right part is the meeting from yesterday. So what we can see is that in December, when they looked at 2024, 25, and 26, you could see how they expected rates to be falling, except for one guy who was at the top outlier and expecting by 2025 that rates would still need to be higher. But there was also one person who was expecting rates to be far lower, like 2.5% by next year. So a big spread in December. What we can see on the right half of the chart is each of the boxes has squeezed and moved up a little bit. This is the Fed telling us that they expect now the economy to remain stronger for longer, and therefore fewer rate cuts are on the horizon. You can see the little boxes, the little square boxes around each of the 6 groups. That's the median. And so we can see right now, there are fewer outliers to the downside after the March meeting. There's still one guy who's an outlier to the upside, but each of the medians is starting to rise just a little bit. So that means that the policymakers at the Fed are assuming that rates will stay higher for longer because the economy is staying stronger than expected. And the good news out of the Fed meeting is that they didn't signal that the economy was too strong. So they're expecting 3 rate cuts, and they continue to expect 3 rate cuts. Had they come out and said, you know what, we might only get 2 rate cuts this year, the bond market would have bounced, the mortgage rates would have climbed. And the reason I wanted to bring this up is because we generally have been expecting mortgage rates to fall. The zeitgeist has been expecting mortgage rates to fall for a year now, and they've only really gone up. They've gone up since the beginning of the year. They're over 7% right now, maybe trying to dip back below, but hasn't happened yet. So if you are a buyer sitting on the fence, waiting for rates to fall, how long are you going to wait? And then we can look at and say, what's going to happen if rates rise from here or rates fall from here? And that's what we'll dive into next. So what the signal we got yesterday from the Fed is that rates are likely to stay higher for longer. Um, they're not, they're still likely to come down in this year, but less likely than they were last quarter from the Fed met. So that's the signal that we're getting there. Earlier in the week, I was a little worried that we might come out too hot out of the Fed meeting, meaning that we would see mortgage rates jump today. They did not jump today. So that's at least a good signal on that front. That leads us into the inventory conversation. There are now 507,000 single-family homes unsold on the market around the U.S. As mortgage rates rise, inventory rises. And in this chart, we see a decade of inventory. And in the rightmost red section, that's when the last 2 years, interest rates have been rising. And 2 years ago, basically to the day, was the last time we saw mortgages in the 3% range. They've moved by the end of March, they were well into the fours. By April, the end of April, they were in the fives, and in May, they were in the sixes. So they rose dramatically in the second quarter of 2022, and that's that start of the rightmost red box here. At the same time, inventory rose dramatically. As rates rise, demand slows down, and as I say, demand slows, so inventory grows. We can see the January dip each of the last 2 years, and the January dip of this year at the far right end of the chart was higher than the year prior. Interest rates were higher most of the year, so inventory was higher. Inventory is climbing now. Right now, inventory, we have 22% more homes on the market now than a year ago. We have 105% more homes on the market now than 2 years ago when rates started climbing. So there's 250,000 more homes on the market right now than there were 2 years ago. What's interesting about that is that while inventory is growing basically everywhere, there are still a handful of states that have less inventory than a year ago. Nevada, New York, New Jersey, Illinois, just a few of the states. I think 5 states still have fewer homes on the market now than a year ago. But each of those states that is compressing. And so by next month, we should see probably maybe only Nevada will still have fewer homes on the market than a year ago. But they're all climbing. And if we look at this chart here, at the map of the country, we can see the Gulf states from the Florida market, Southwest Florida in particular, across New Orleans through Texas. Those are the markets where inventory is rising most rapidly. So Florida has almost 50% more homes on the market now than a year ago, where New York is still 9% fewer homes. And in fact, we're going to look at Nashville later on. Tennessee, there's more homes on the market in Tennessee than there are in New York. And that just blows me away. Tennessee is up 16% year over year. And so what we can see is inventory climbing, and and we can see exactly where it's climbing most dramatically. And then we're also going to look at what are the impacts of that? Are there risks, for example, in Sarasota of home prices falling because inventory is too high, too much supply for the current levels of demand? So we're going to look at that a little bit as well. But we can really see where that impact is. Though inventory is climbing, for example, California last month was still negative year over year. Now California is a little bit positive. So the whole country is moving, growing inventory. Some of those Northeast markets, the lighter colors there, are just now coming off their pandemic lows of inventory. So they're positive year over year, but they're still barely coming off the pandemic lows, where like Florida is back to 2019 levels, pre-pandemic. So There's some big differences. When we look at the new listings volume each week, so the sellers that are listing each week, we can see in this chart, each line is a year. The gray lines are years past. The light red line is last year, and the dark red line is this year. And what we can see is each week, slightly more sellers than a year ago. So consistent growth over last year. There were almost 60,000 new listings that are unsold this week, meaning they didn't all we watched them over the last week and they're not already in contract. There's another 16,000 that are already in contract, but those 60,000, you can see more than last year, consistently more than last year. Last year, that was in 2023, the characteristic of the market was how few sellers there were. People were just adjusting to the newly high mortgage rates, and they were sitting way back. Now we've had 2 years of high rates, and so we can see sellers easing back into the market. We can also see that if you look at a lot of these gray lines, this time of year would have 80,000 new listings in a given week. So that's like 2019, 2020, and we only had 60,000. So we still don't have a lot of sellers. So if you are working with buyers or sellers who are afraid of a big surge of inventory, they're afraid of the market tanking, rates are high, and we expect a big flood of distressed inventory or something where they might be selling. The data is showing us that there is no sign of a big flood of new inventory. We see a little bit of growth, which I think is terrific. I'd like to see more, in fact, sellers, because more sellers allow more sales to happen. But what we can see is a little bit of growth, but not a lot of growth. And I think that's an important message, an important data point to take to buyers and sellers, because there's a lot of folks out there who have their mind made up and they think that the market is tanking, and they think that or maybe they're only in Austin, Texas, or they're looking in Southwest Florida, and they think that is representative of the whole country, and it is not. Okay, so I mentioned that there's 60,000 new listings. There's another 16,000 that we call the immediate sales. And the immediate sales are those that they get listed, they take offers, they go into contract essentially immediately, days or so, a couple days after listing. During the pandemic, right up through July of 2022, that was the defining characteristic of that boom, was how many multiple offers and bidding wars and going into contract is, we're coming soon. And so the contracts, we're taking the contracts the day it gets listed. And so we could see in that 2 years ago, about a third of homes were going into contract immediately. What we can see now in this chart, each bar is a week, and the taller the bar, the more sellers there are. The light portion of the bar are the ones that went into contract immediately, and the dark portion of the bar adding to inventory. So at the far right end of the chart, you can see this week. And this week, there were more new listings than almost any time except for the peak of last year. The last year was super restricted all year. The immediate sales, there's 16,000 immediate sales, so we can see more transactions happening and more listings happening, but still a lot fewer than 2 years ago. And this moment 2 years ago was when the mortgages really started to change. So what I look for with the immediate sales number is, are the new listings growing? Does the dark part of the chart grow here, but the immediate sales shrink? That would imply that we're having more sellers and fewer buyers. So in a rising mortgage rate environment, if rates jump from 7 to 7.5, for example, from whatever economic news drives it there, we would see that immediate sales start to fall. If that falls too quickly, like it did in the second half of 22, then we start being able to foresee home prices drop. And we could see exactly that happen. And really, it's July and October of 22 when home prices dropped. Last year, we can see the immediate sales were actually pretty strong all year long relative to the total number of listings. And last year was an up year for pricing. So you can use the immediate sales as a gauge of demand. And as we gauge demand, we can watch it to know whether future sales prices are dropping. As of right now, the rates stay steady here at about 7%. We can see slight growth in the immediate sales, and meaning that demand, the buyers are there and are trying to buy homes. If rates jump, consumers are more sensitive to changes in rates than to the absolute levels. So if they jump from 7 to 7.5%, then we'll see that shrink and we'll be able to watch it right here every week. So that's what we can see right now. Let's look at this from, we look at the new listings compared to the year prior. What we can see here is, so each week we're comparing the new listings versus the year prior. So in the first half of at the left end of the chart, the first half of 22, we had sellers who were lurching into the market. They were coming into the market, trying to get out before mortgage rates rose. Everybody could see it 2 years ago. And it peaked in July of 22 and then fell off a cliff. But if you're listing your home in July of 22, you already knew you missed the window. And so either you didn't list, you held back, you listed at a discount. And so you could see this really sharp point here, the 4th of July weekend of 22. We had fewer sellers all year long. Then starting the second half of last year, starting July 4th, we started to get some growth. And what we can see now, and so this week there were 24% more new listings than a year ago. So that's strong growth. And what we're looking for is continued at the right end of the chart, continued above the zero line here. We have more sellers each week. But if it's surging, 24% is actually kind of a lot. And I expect it to dip back down. But this could be a signal for things changing. And if we're watching, for example, investors get cold feet, then you could see the new listing surging. So I expect to see growth, 10, 15% more, 20% more sellers, and that will lead to more sales for 2024. In general, I see this as a healthy pace because last year, all that whole period was below the line, meaning we were shrinking the number of sellers and shrinking the number of sales all year long. But we're now finally have turned that corner. We can look at the future of listings. So one way to figure is we can watch coming soon properties. Now, not everybody in every market does a home as a coming soon, but when you have a really great property, it's an excellent marketing technique to put the yard sign in, market it as coming soon before it's actually open to take offers. And what we can see is there's just about 3,000 that we counted this week coming soon properties. And you can see how there's already more than last year at this time. Not quite as many as the peak of the pandemic in 22, at the end of the pandemic, but we can also see that, so what we know is like, there's already more coming soons, which means there's going to be we can already see more listings when those come to the market. We can also see that July moment in 22 when the coming soons dropped off a cliff, right? If you were listing, if you hadn't gotten out in June, you're not putting a coming soon in July, is much less likely to do that than you were a month earlier because it was already past the window. So we can see exactly the future happening in the coming soon listings. And right now it's telling us that we are going to continue to have listings expand throughout the year. And let's put that all together into the projection. So when we talk about inventory for the year, in this chart, each line is a year. Inventory is generally at the lowest in the early first quarter. It starts climbing in March, April, May, usually peaks in August before it then declines for the holidays and then resets to start in January. We can see where most of this chart is about the boom years, 2020, 21, 22, 23. And during the pandemic, the pink line was 2020. And you can see starting in April, rates were falling, excuse me, and inventory was falling. And so inventory was falling dramatically in 2020. Now we are in 22, we were in a rising rate. So that 22 started with the record few homes on the market. And starting in March, inventory started climbing. By April and May, it was climbing dramatically. And then 23 actually had more buyers in the first quarter than we expected because rates fell pretty much through January, February. This year, rates have been rising since January 1, so inventory is rising. What this means is that we are looking at maybe 610,000 single-family homes on the market to end the year. That's an increase of about 15, 20% over previous year. It doesn't yet get us back as a country to the 2019 levels. So we have a few markets like the Florida markets, like some of the Texas markets that are back at 2019 levels, but we have a lot of the country, Boston and Cleveland and Cincinnati, like that are still barely coming off the pandemic lows. So as a country, we're starting to normalize, and the longer rates stay higher, the more inventory grows, and we normalize back to previous years. So multiple years of rates staying higher will get us slowly back to the 2019 levels. It wasn't that long ago when we would have 1 million homes on the market right now, and there's 500,000 currently. So if rates fall from here, rates are at 7 now. If rates are at 6.5 by June, or below 6.5 by June, you will watch this inventory growth recede, and we'll actually watch buyers come back. We'll watch transactions, more buyers than sellers. So lower rates will spur demand more than supply, and so inventory will tighten. But as of right now, the forecast looks like we're going to keep on a normal curve for the year, peak in late summer before declining for the fall. But if rates fall, and this is one of the important points for buyers out there, there's a lot of buyers who are wanting rates to fall. Makes sense, right? We want to wait, rates get cheaper. That'll be a lot cheaper for my payments. That would be great. What those buyers who are waiting may not realize is how much competition is waiting with them. So everybody's thinking that, right? If rates fall, it's much easier to buy a home. And so if rates fall, if they fall appreciably in the next few months, you'll be able to see demand spurred. We'll see more transactions. We'll see inventory tightening up. And we'll see more competition for buyers, especially in those markets that aren't actually weak right now. And so places like Southern California, there's a lot of cash buyers and things. There's some of there's strength in a lot of those markets. There's not a lot of inventory, even though it's climbing a little bit. And so if you're in a market like Southern California and you're waiting for rates to fall, you're going to be faced with super tight inventory and a lot of buyer competition. So that's something that buyers should keep in mind. They may still want to wait for cheaper money, but they should know that very clearly. Okay, let's switch to the pendings. These are the sales that are happening. There are currently 345,500 single-family homes in contract. That is 5% more than last year at this time. So a little bit of sales growth. We are in this chart, each bar is a week. The taller the bar, the more homes that are in contract. The light portion of the bar is the new contract started in a given week. So what we can see here is slight sales growth over a year ago, last year. and significantly fewer homes in contract than 2 years ago or 3 years ago. Like obviously, we are not anywhere near back to the boom levels of home sales. And when you think about home sales, you might be familiar with the NAR number, and they might say 5 million or 6 million seasonally adjusted home sales is commonly a number. So it's 6 million during the peak in 21. Last year was 4 million, so a third fewer. And so you can see the bar is a third lower in than it used to be. And so those are the sales, significantly fewer sales happening. But we can see slight growth year over year. What we noticed was at the beginning of this year, we were looking at 15%, 20% sales growth. As mortgage rates rose from the mid sixes to over 7% since January 1 till now, the growth, the home sales growth shrank. And so we lost a lot of the momentum that I was looking at the beginning of the year. And even a month ago, in the February data, I was still kind of optimistic about it. But if rates will finally stay stable at 7% or tick down a little bit, I think we're going to see this growth start to emerge again. There are different ways to measure home sales. We're tracking every home that goes pending each week. The Mortgage Bankers Association is tracking the mortgage applications, the purchase applications. And if there's more of those, there's more purchases happening. The mortgage purchase application number may be undercounting growth in purchases because there's a lot of cash buyers, especially in places like Orange County or places like that in California. So it could be that we're shifting a little bit to cash buyers in this expensive money environment. And so the sales growth is, by watching the pendings, we can see exactly a little bit of growth here. When we look at just the new contracts each week, and this is, these are new contracts started, and I've trained it here. So we have each line is a year. You can see the dark red line. The dark line is 2024, and you can see how we're in between 22 and 23. We have more sales than last year. Still not as many as we had in the first half of 22. You can see that July 4th point of 22 happening here exactly. You could see the new contracts fell off a cliff in July and again in October of that year. And so in this July, the pink line in July and then again in October, and those were those big moves in mortgage rates that slowed buyers down dramatically at both of those times. So if rates stay steady by the second half of the year, I think we could be significantly nicely above the last 2 years of growth. If rates climb from here, we can see exactly how sensitive consumers are, and this purchase rate will drop, will fall really quickly. So like that spike in September of 22, the pink line, it dropped very quickly in that September-October window, because that's when rates spiked from 6.5 to 7.5 and shocked people again, and they backed off. And as I've mentioned, consumers are more sensitive to changes in rates than to the absolute levels. So if they just stay here at 7, then we're going to see slight continued growth over the previous year. If they jump to 7.5, we can see exactly what's going to happen. And that's when those consumers who are shopping now, things get suddenly more expensive and they back off. So this is the new contracts each week, and it's a really excellent view. We started at the very left side of the chart here. You can see we started January with sales growth each week, but then as rates rose pretty quickly, January and February was barely any growth. I think now by April, we'll start to see good sales growth over last year. Fingers crossed on rates cooperating. And then if we look at the change over time, we can see the market is growing in this chart when the new sales are above the line, this dashed line in the middle. The market is shrinking when the data is below that line. This week, there's 15% more sales started than a year ago. That's terrific. There is most of last year, we were 20 or 30% fewer sales happening than a year prior. So as long as we stay, most of the previous weeks recently have been above the line, and that's showing a slight growth in home sales. And so just counting each contract that gets started each week. So 15% more this week. It's interesting. Last year, March 18th week, we had was when we had three big bank failures: Silicon Valley Bank, Signature Bank, and Silvergate. And it looks like, in retrospect, we might be able to see some of those sales that got put on hold for a week, or maybe didn't happen at all after that moment. And so our comparison was strong this year because we didn't have bank failures this year. So a little bit of growth is what we're looking at there. We can see days on market, and each week, we're actually just at the peak of days on market because we start to get most of the transactions happening in the second quarter, and the stuff from that was listed late last year is now filtering off the market. So we could see slightly more time on market than a year ago, but pretty significantly longer on the market than 2 years ago. And I'm going to show you some days on market, different price ranges in the different local markets in just a minute. Let's switch to pricing. We'll do a couple of pricing, and then we'll switch to the local markets. The median price for single-family homes in the U.S. right now is $435,000. So if you walk out into the market and want to buy a house in the U.S., the median is $435,000 of what you can buy right now. That's 3% greater than it was last year at this time. We finished the year 23. We finished with about 5% home price gains. So it's compressing a little bit as rates have risen this spring. So there are signals in the data that are less bullish than last year at this time. And last year at this time was really surprising, right? We'd come off a really cold fourth quarter. And so seeing demand in the first quarter of last year was really surprising. But those leading indicators left us with about a 5% home price gain in 2023 over the previous year. And in March of last year, I was not expecting home price gains. I was still expecting about flat. But we got home price gains during the year because we had supply limited, we had reasonable demand, and people were able to buy what was on the market, and therefore we had slight home price gains. Because inventory was so restricted. This year, we have slightly more inventory and slightly lighter demand as rates are higher. And so the signals are really looking like flat for home price appreciation for this year. If rates jump from here, that's going to correct down really quickly like it did in July and October of 22. And we could see that again if rates jump from here. And as I always say, I don't predict rates. Rates could go up, they could go down. I've been wrong on mortgage rates for 30 years. I'm not sure anybody can predict mortgage rates, but we know what will happen if rates go up, and we know what will happen if they go down. And we know what will happen if they stay the same, because if they stay the same, we're going to see slight growth. We're going to see growth in transactions. We're going to see slight growth in inventory. And so staying stable is actually bullish for the whole market. The bright red line is the median price of the new listings. That's just under $420,000 this week. And the key here is that what we're looking for at the right end of the chart is how steeply sloping up the bright red line is, because that's the new listings each week. And the sellers and listing agents, they know how much demand is out there, and they know how many people came to that open home down the street. They know how many offers were on any given house. And as a result, they know to price the next one at a little bit of a premium or a little bit of a discount. And we can see 2 years ago, the bright red line shot up in January and February, March of 22, because people knew that they had to get in before rates jumped. And so each week it was super hot, and each week the new listings appreciated. Last year was much slower. This year is slower. The good news on this is if you're bearish on housing or if your buyers are bearish on housing, the signal here is there's nothing pointing downward on home prices. There's no signal of too much inventory nationally. There's no signal of buyers walking away that would push downward. So, but really, it's about flat, give or take, on home prices for 2023. And that price of the new listings is house gets listed now, and maybe it gets an offer in April, and that closes in May, and you start hearing about that in June. And we can really see now what's happening with that. And so it's an excellent leading indicator for future sales prices. Let's look at the homes in contract. So this is even closer to the sale. So, they go into contract, and now the homes that are in contract now will close mostly in April, and some in March, some in May. But so we can already see that home prices, the homes in contract are at $389,000. That's 4% higher than last year at this time. And each line is a year. And we can see a couple of things in this chart. There's last year in the second quarter, we had home prices were below the previous year. And the headlines were reporting year over year, home prices decline, home prices decline. But the declines happened in July and October of 22, but they didn't show up into the yearly comparisons until this gray section, March, April of 23. And so what we can see right now, the dark line here is home prices are up. They're compressing a little bit because rates have been higher. But if rates stay about 7, I think we will expect prices to ratchet up through June and then taper off to the second half of the year. And you can really see how last year, the bright red line started the year below 22 and ended the year above 2022. And so you can see that's where that shift was happening. And that happened because home prices adjusted in July and October of 22. And that's how we know how sensitive buyers are to rate adjustments now. So if rates drop to 6.5, you're going to see that accelerate both purchases, sales prices. You'll see it in contract. We'll see all of that strength across here. If they jump to 7.5, then you could see these price ratchets down again. So it's really clear, and we can see it pretty much to the day. This is maybe a week after those rate changes before it shows up in the pendings data. So this is all the homes in contract. And right now there's 350,000 or so single family homes in contract. So we know that prices are up 4% over last year. And those signals remain reasonably consistent. There is, though, something that on those price changes. So this is now looking at that same data spread out over a couple of years. And here's that October, this gray is that October moment of 22. And you could see how those pending home sales prices were changing really rapidly in October, so that then by second quarter, they were year over year negative. We could see them changing positive all of last year, but that changed after January because rates climbed. And so again, if we stay stable here, this decline at the right end of the chart is probably done. But if rates jump to 7.5, we're going to see these prices dip again like we did. And so it's worth paying attention to. We know exactly how sensitive consumers are to rate changes. And so we could see it right here. So we'll keep an eye on that. As of right now, these are 4% gains. It's a little less than it was when we started the year, but we'll have excellent visibility as the year progresses. And then the last leading indicator before we jump into the local market. So this is percentage of homes on the market with price reductions. There are now just under 31% of homes on the market with price cuts. And each line here is a year. The dark line here is the sort of the left end of the chart. This is where you can see now more price cuts now than a year ago. Last year, price cuts were still falling, meaning there was fresh inventory, people were buying it, the homes were not taking price cuts. About 30% did, but it was still fewer each week. Now we're in a climbing each week. And this is one of the leading indicators that tells us that the price signals for the year are less strong than they were last year at this time. So last year by March, so it's April, the headlines are showing year over year price reductions, prices falling in April of last year. But the data, the leading data here was showing us price appreciation because price cuts, there were only 29% of the homes had to take a price cut. Because there was enough demand, people were buying at these prices, right? So the leading indicators were much more bullish right when the headlines were the most bearish. So what it tells us now, though, is slightly not as good as last year. It's ticking up. We want to watch how quickly price reductions tick up. And like I said, we can watch this really to the week of if mortgage rates jump, we can watch price cuts jump as well. So we're going to keep an eye on this. As of right now, price cuts are in the normal range. It is not uncommon for price cuts to start climbing in the second quarter. Homes that were listed in the first quarter now didn't get their offers. They take cuts. Price cuts peak in the fourth quarter before they reset before the holidays. But with the signal we can watch for here is the sensitivity to rates. And if rates move from even to 7.2, I bet we see an uptick in price cuts. So if you're shopping at 7 and suddenly rates are 7.2, some people don't make the offer. Some people can't afford it or don't want to make that payment. And so that everybody doesn't make the offer. Now the listings don't get the offer. Some of those opt to cut their price to get to incentivize. So even a move from 7 to 7.2, I think we'll see a change in price reductions. And that bodes for transactions that happen later in the year. And really what I like to do here is let's look at price reductions at the local level, regional level, metros, and I'll show you where the demand is across the country right now. So this is the Altos platform. I've got up the advanced analytics part. We can look at the reports section, and this is where I happen to have all reports for every zip code in the country, but in your market, you'd have your reports for your market. I have 8,000 people viewing my reports this week. I have 140 new leads in my inbox this week. These are people who are opting into the reports. I can see 15,000 of those folks are reading their emails this week. And so, but we're looking at the advanced analytics. And in particular, I have a rank here of price reductions across the country. And these are metros. These are big metros, so at least 1,500 homes on the market. And look at what we've got here for where the most price reductions are. There's Southwest Florida, West Florida, Southwest Florida. We have Central Florida, Southwest Florida. And so we've got all of these Florida markets before we get to Arizona. And so we can really see that happening. Florida has big changes in affordability this year, in particular in insurance. And especially, I think a lot of these Southwest markets are really feeling that. I think that may be contributing to this change. So in many of these markets, in the country, about a third of homes is normal to have a price cut. About a third. Some of them are intentionally overpriced. Some of them are accidentally, but about a third take a cut. So when price cuts are in the 50s, that's a pretty cool signal. That means there's more than half of the homes on the market have taken a price cut. That means there's fewer buyers, significantly fewer buyers than people expected. And so we can see that in Sarasota and Punta Gorda, and we can see that all the way across. We can see it ticking up that in these last few weeks. So these little spark lines here, this is several years, but we can see, and so you can look back during the peak of the pandemic, right? Significantly fewer price cuts, and now we're at 54%. And we have it, so these are really notable signals in the market. All of these guys are are climbing right now. So that bodes. So these are the first signals that there are real price pressures in Southwest Florida because of the growing inventory and light demand. Phoenix is this first non-Florida market. Phoenix is much more commonly to be in the 40% range. Phoenix has a lot of investors. So much more commonly, this is sort of much more close to normal for Phoenix at 43%. We can see that in that, remember I was talking about that October of 22 when prices really dropped. And that was, at that moment, 63% of the homes in Phoenix had taken a price cut. So Phoenix is significantly better supply and demand balanced than it was 18 months ago. And I think that's really important. Where if you look at Sarasota, 50% where it's actually slightly less balanced now than it was 18 months ago. And I think that's a real signal. Austin was at the peak, was the highest price cuts almost all of last year. Austin really looks to me like it has found its floor, like it found and price like has found its floor on pricing and has achieved much more balance, even though Austin is now back to 2019 levels, or in fact higher than 2019. Like Austin has more inventory than it has in many years. Not a lot more, but like it's normal now. And so Austin looks much more healthy than it used to be. Went from 60%, 61, 62, now is only 38% of the homes on the market in Austin have taken a price cut. So that's a really significant change for Austin. So we looked at Sarasota, and if I look at the regional data for Sarasota, we can see a bunch of things. So in your Altos report, we can see the speedometer here, the market action index, has just barely into a seller's advantage. It's a balanced market. If it falls into this buyer's territory, that's really a signal of significantly more sellers than buyers, and likely a downward pressure on pricing. So this balanced market is really the coolest that Sarasota's been in many years. And we can see it here if we scroll down into the inventory chart. I've got the inventory chart up here, and we can see 5,500 homes on the market. That's more than when it was in when we started the pandemic in 2020, and basically back to the 2019 levels of inventory. So 5 years of inventory shortage, and now we're back to normal levels. And that's really significant. You can see a real significant climb this year. And so if you're in that Southwest Florida market, you're a buyer or a seller here, you know exactly this. So if you're working with sellers in Sarasota right now, the message is, we know that inventory has been rising, and I'm going to put this report in your inbox every Monday. And we're going to watch one number. We're going to watch this market action index. If this number falls while we have your house listed, that means that's the market telling us the balance is getting out of our favor, and we might want to get ahead of that and do a price cut to get ahead of any weakness that other people aren't yet on the ball with. So you sit at the listing presentation, you go like, I'm going to put this in your inbox every Monday, and I want you to look at one number. So that's Sarasota. And we can also we can see all price ranges, 50, 60 days or more. Let's contrast that to San Francisco. So in the Bay Area, we have inventory is basically at pandemic lows. Certainly lower than a couple of years when we came out of the mortgage rate change. And look at this. If we look at the price ranges in San Francisco, anything under $2 million is moving in 14 days or less, right? We can see exactly where the demand is. And so in some of these California markets, we can see more cash buyers. So people who are maybe less sensitive to interest rate moves. We can see inventory is ultra tight, and the mortgage rate lock-in effect is much more extreme in California. It's mortgage rates it's also property taxes that you're locked in. So your likelihood to move in California is significantly lower than in other states because everything changes and your property taxes don't go up in California. So that keeps inventory ultra low. Boston may be the hottest market in the country right now. I'm going to switch over and do Nashville. I mentioned that Tennessee has more homes on the market than New York right now. I think it's the seventh, eighth most in the country. But this is actually not unusual for Tennessee. So Tennessee is where Texas and Florida is back at the inventory levels pre-pandemic. Tennessee is not climbing, but still has has almost normal levels. And this is Nashville of inventory. We can see exactly where the demand is in Nashville, which is under 500,000. The demand picks up under 500,000. We can see a slight sellers market compared to just that balanced but more inventory per capita than say San Francisco. So we are you can see how that is slightly tighter market. And if we look at price decreases in Nashville, we can see that we have only 26% of the homes on the market taking a price cut, which is right in the normal, a little less than normal. So that bodes well for pricing in Nashville for the rest of the year. And folks, I have gone right up to the time, right up to the hour. Thank you all for sticking around. I will just leave you with this. I can't get to every market, and there's a lot of local markets. If you want to see your local market, book time with our team. You go to altosresearch.com, get started now, grab your reports, you get your training time with our team. We'll walk through your local markets. We'll walk through your how to talk about your data with your buyers and sellers right now. So I just recommend that you go book that. And I'm right up to the top of the hour. So thank you all so much. I'll stick around in the chat. There will be a recording, and you'll get that email later today. Thanks, everybody.